Hello and welcome to the Global Forecast. My name's Tony McMahon, and as ever I'm joined by Robin Bew. Robin, cutting the public deficit is a central issue in the UK general election campaign that's running at the moment, but is it also an issue around the globe? And to what extent do public spending cuts threaten to choke off recovery?
Well, almost all developed economies need to look at some sort of fiscal consolidation. Spending cuts is by far and away the best way to achieve that. As all the theory, the academic studies and experience suggests that spending cuts are the way to achieve more sustainable and lasting fiscal improvement. But unfortunately, given the scale of the deficits we see around the world, you're going to see tax rises pretty much everywhere as well. And in some countries, you're going to see more tax rises than spending cuts. So it's certainly fiscal consolidation is a global theme, but many markets are talking about taxes rather than spending in order to achieve that. But I can't think of many rich countries that aren't in a position where you're going to see significant tightening over the next few years.
To what extent do you think that public spending cuts could fuel unemployment rates, and what impact would that have on consumer confidence?
Well, clearly the trick for politicians is to withdraw the fiscal stimulus, which is a polite way of saying higher taxes and lower public spending, at a pace which matches that at which the underlying economic recovery takes ground. So what you want to do is gradually remove the crutches from the patient, but not so quickly that they just fall flat on their face. And that's the big worry right now. So how quickly can you consolidate? So the UK, one big political theme is, do you do all the cuts right after the election, or do you wait till 2011, 2012? So the Liberal Democrats and Labour looking to do everything next year. Tories at the moment slightly unclear, but looking probably to do a bit more this year, so their sense is the recovery is a bit more robust. But clearly, I mean, if you remove government spending or put higher taxes in, that will unambiguously make the economy weaker than if you weren't doing that. Now, clearly there is a little bit more of a nuance because public spending drives up longer term interest rates and that crimps the private sector's ability to borrow, but I think in all reality, clearly, as you pull out public stimulus, it's going to lead to the economy struggling rather more than it is at the moment. And I think we need to be realistic that what that suggests is that fiscal consolidation is a must. It has to happen, because if you don't see that, then money markets are going to get out of control, higher interest rates, and the economy is going to look very sick indeed. But that withdrawal of stimulus means that the recovery is going to be much, much weaker than anything we've experienced in recent recessions and upticks during the cycle. And I think we just need to be braced for the fact that not just in the UK, but in Europe, Japan, and even in America, the recovery is going to be a lot weaker than people are hoping.
With regards then to whether or not public spending cuts in the UK should get underway in earnest in 2010 or 2011, does the EIU have a point of view on this?
Yeah, I think that most of the tightening is going to have to happen in 2011. There is an issue around the money market's reaction and what would happen to long-term interest rates. I think the really key thing after this coming election is that there's a credible plan. That plan doesn't have to be executed in a very significant way during this year, but it has to be something that the financial markets believe in. So if they see a little bit of tightening now, but there's a very credible story about how there's going to be much more coming down the pipe back in 2011, I think that's okay. Lots of tightening now, I think you could snuff out the recovery because it simply isn't that strong. But no tightening now and no story about what's going to happen in 2011 is equally bad, because then you're going to see sterling fall through the floor and interest rates go through the roof. So I think the really key thing is a credible story. And of course, politicians struggle to put together credible stories about spending cuts and higher tax. And so to me, that's the really difficult bit. And you probably have to put something into effect now just to make the markets clear that you're serious about doing more in 2011.
Turning to Japan, the forecast this month says that the spectre of deflation is re-emerging. Is that the case?
Well, I mean, they've never really fully broken out of this. Deflation has been either a recent memory or an imminent prediction for about 15 years now. So I mean, it's not as if we're saying that Japan have broken out of this cycle completely, is now going back into it. But I do think that they have got a serious problem, that when you look at their economy, and clearly their fiscal position is appalling, much worse than other OECD economies, certainly in terms of the debt stock, if not in terms of the size of the deficit. So their room for manoeuvre is pretty limited. They're moving into ageing population. Trend growth is extraordinarily low because the population of working age is already shrinking quite sharply. So for them, it's very, very difficult to see where the growth is going to come from. And our worry is there that having spent 15 years really dodging the bullet in terms of this terrible fiscal situation, really starting to weigh on their economic prospects and on what financial markets think about them, they're gradually moving in towards a situation where they're going to need foreign funding to support the fiscal deficit, which hasn't really happened before, and I think it's just going to get more and more difficult for them. So very, very problematic picture when you look out, not just over the next couple of years, but actually over the next 10 or 15 years. I think very, very tough.
Japan may be sluggish, but according to the forecast, it looks positively robust compared to the Eurozone.
Well, mainly in terms of the macro story. I mean, obviously everyone very disappointed to see even the big economies, say Germany, what happened to them in terms of their macroeconomic stats growth there, much weaker than many people have been hoping. And if you look in terms of fiscal deficits, obviously you need to look to the periphery, but you know, Greece clearly, Spain, Ireland, you look at all that. I mean, they've got much worse fiscal deficits than Japan, although not much worse debt stocks. So if you look, I think in the short term, all looks pretty difficult in Europe. No growth in a really big economy, terrible fiscal situation. I mean, so terrible that we are seriously talking about a bailout, and if we weren't talking about that, you could be talking about default. I think that's very unlikely, but bailout looks almost certain now. So the short term looks terrible, but I think when you look out into the long term, Europe has a lot more levers to pull to get their economy moving again. They actually have a lot more goodwill in the financial markets, a lot more slack to make structural changes to their economy, whereas Japan, they've left it far too late. Inaction for far too long now means that for them there are no good options, whereas in Europe you can imagine that in a couple of years' time Germany will be going robustly again, that the Greek fiscal position will be on a downwards movement and you'll be more confidence that the long run picture is better there, whereas in Japan it's very difficult to feel like that.
Thank you, Robin. Well, join us again next month for more analysis of the world economy in Global Forecast. Until then, thank you and goodbye.